Hi, everyone. This is Rohit from Rise to Mastery, and today excited to have Minnie Ingersoll, who's a partner at TenOneTen Ventures, which actively invests into great teams. They invest early and love working with technical founders who are passionate about what they're building. Prior to TenOneTen, Minnie was a founder and CEO at Shift, an online marketplace disrupting the $1.2 trillion car industry by providing a better experience. She's a host of LA Venture podcast, and she's done an MBA from Harvard Business School and a Bachelors from Stanford. Welcome to the show, Minnie.
Thanks so much for having me. Glad to be here.
Awesome. So you have a very interesting journey. You started from MBA. You worked in Google. You did your own thing, and then you got into investing. What got you really interested to get in to the crazy world of startups and VC world?
Mostly I fell into it. At some point, fairly recently after I had exited Shift, I realized that my skill set was really early stage companies. I don't
Right.
think I could be at a later stage company. I'm not sure like the structure would really work for me. I love starting things and then I grow out of them or they grow out of me. And so being at the early stage, it finally dawned on me like that's kind of what I have grown into and that's where my skill set is. And I like the sort of fast and messiness of it all. And I think it's lucky because there's a lot of, fast, messy startups to be around and I enjoy it.
Very interesting. And you went to Stanford and Harvard. Did you always want to go to Stanford and Harvard for your bachelor's and MBA?
Yeah, I mostly did always want to. So I'm from Southern California and Stanford was kind of my dream school. Like it looked amazing. And you go visit the campus. It's beautiful. Everyone's out playing frisbee, and yet everyone's really smart. And I got there, and actually, it was really hard.
Yeah.
um, so the freshman year it was sort of more fun, but I got into computer science, and this is the '90s.
Right.
And CS was a really hard major, and so by kind of my last year at Stanford, I was starting to wonder whether I really was as smart as some of my peers or something. I was a good student, but then now I look at my peers and it's like Marissa Mayer, who was the CEO of Yahoo, and sort of the Larry and Sergeys of the world, and it's like, well, okay, so I had a tough peer group to compare myself to, but I think it did give me a good perspective on just like what really good looks like. So, yeah. And then Harvard Business School, yeah, I think I did want to go there, but also there was a function of, um, I was at a startup that had IPO'd in March of 2000 and then the market crashed. And so there was a little bit of everyone was doing layoffs and the dot-com boom had bust. And so business school was kind of a chance to catch my breath.
Oh, interesting. And I know it's a controversial question, but why Harvard for the MBA and why not Stanford?
Oh, I didn't get into Stanford. I might have gone. I might have gone to Stanford, although I probably would have. um, but in retrospect, actually, I'm from LA. I'm
Oh,
very sort of California-ish, I would say. And so being in Boston and going to business school, I think it really helped me understand, as soon as I finished business school, and this is 2002, I came right back to California, and it sort of helped
oh,
me understand where I fit in the world. Um, and uh, and in 2002, I was one of the only people that, I tried to get a bunch of my friends to come work at Google, and they wouldn't. People were not really interested in Silicon Valley at the time. So I'm glad to have had that experience, and it was a good experience.
interesting. And you talked about Google. How did you get your job in Google? And why did you look at? Wasn't a very known startup back then, but how did you get your entry into Google?
Gosh, we have to go back a ways, right? It's 2002. So,
Right.
so a few things. Number one, there was on the homepage, it said, "You're brilliant. We're hiring." And my
Oh,
mother, my mother took a screenshot and sent it to me and was like, "Minnie, look, they're hiring." And and I was graduating from HBS, and everybody else in my class had a job, and they were all going to be management consultants and bankers and private equity people, and they all had their jobs lined up like 5 months ahead of time. And I was determined to go find a startup, and Google was already 500 people. And I was like, it's so big. I'm not sure. It's 500 people already. But it turns out, obviously that was just the beginning. But then also I was really into the Google toolbar at the time. And I thought that Google toolbar was this brilliant product that got me all excited about how convenient search could be. So, pretty random, but also I'd known Marissa, I'd known some of the early Google people. But yeah, I mean, when I interviewed with Eric, Larry, and Sergey, and Salar, and Susan, and, Marissa. So it was quite a great place to end up.
Yeah, interesting. And you spent close to 11 years in Google. What was some of your biggest takeaways from Google? I understand the interview process was very rigorous, but what was your experience while staying in Google?
Yeah, I mean, so much. I think, now with a venture capital hat on, it's kind of interesting how Google sort of resembles a VC fund, or Alphabet does, really, in that, every time you might have had an idea or something, and you want to go pitch the Google leadership, the question was essentially, is this a $5 billion business? And because really, once you're at Google scale, you can't, you can't take up, Eric, Larry, Sergey, you can't take up their time with sort of like, I've got this new little feature that might change things a little bit, right? It has to be world changing ideas. And, it was interesting for Google as Google grew up, just like, who do they look at? Who does Google, this is sort of pre-alphabet, like, who does Google become? Like, what sort of company both does self-driving cars and does search and email and everything else? Like, what sort of, is that Berkshire Hathaway? Like, I don't know. I'm like, there weren't a lot of equivalents to look at. So, so just that, like, stretching your brain to always think bigger. And then there was just a lot of tactical stuff. So, hiring or OKRs or all of those things that when I then went to start my own company, when I went to start Shift, we just said, let's copy what we thought Google did well, which was a lot of those things. And Google had, I can't remember, but someone just told me it's like 4,000 people in the people ops team at Google. It's something huge like that. Maybe it's, it's thousands and thousands of people. And those people are smart data scientists, thoughtful HR professionals who have thought about, like, what's the best way of setting up your 360 review process. And so, like, they've spent a lot of time figuring out what works, what doesn't work, how many interviews is the right number of interviews for your interview panel. Like, let's copy a lot of that stuff. And so, I probably learned a lot of all that operational stuff and just took it with me.
Right. Interesting. And, after Google, you worked for, Code for America and shifted, Shift. How did that transition happen? And, why did you want to build something in, an online marketplace for cars?
Oh, that's a good question. It's funny because now I'm a VC and I get a lot of pitches for people who are doing used cars. And I'm like, yeah, gosh, now that I've done so much in used cars, maybe I've done enough for one lifetime. But it was a really interesting business, actually, almost more of a data business than a used car business in a lot of ways, because actually, in order to be a marketplace, if you're a reasonably centralized marketplace, which we were, meaning we were doing a lot of stuff centrally as opposed to sort of having it be done by the buyers and sellers themselves. So we were pricing cars, and pricing cars is a really interesting business. And probably you could build a whole business, Shift is much more than just pricing cars, but you could build a whole business that is just pricing cars. And it's a pretty interesting data challenge. So that's one thing, but practically what happened was I was on maternity leave. So, to be very specific about what happened is I was on maternity leave from Google with my first child and thought I'll take 6 months off. I'll really spend time at home with my baby. And then a few months into that, I realized it's not my sweet spot is being home with a baby. And so I just have too much energy to do things, and sort of out of that excess energy that I've always had, my co-founder and I started Shift. He actually had the idea and had been talking to me about it for years. He was at Google with me, and I actually wrote him an angel check. And then I went on maternity leave. And while I was on maternity leave, I fully got sucked in and just, started showing up at his house every day, and thus became Shift.
Oh, that's quite interesting. And you mentioned that were you doing the pricing for the cars, or how does it happen in the marketplace? Isn't it from the supply, where most of the pricing happens?
Yeah, so for the most part, some of our pitch to sellers. So if you've got a used car, Shift says, we will take care of selling your used car for you. And most people are not very good at selling their used car. And so that is sort of the fundamental pitch, which is, one, we will price your car correctly. Two, we will advertise it. And actually, there's all these people who have SEO'd essentially Google, right? Or who have who optimize their rankings on Google. Well, it turns out most people post their car on Craigslist. They don't post it on Auto Trader. They don't post it on cars.com, Car Gurus, whatever. And so when we started, we said, we will just help you get more exposure for your car. We will price it correctly. We will show up to your house. We will pick it up. We will then, you call it car reconditioning, which is, getting it ready for a sale, because especially for the higher end cars, you can put in $1,000 of work and sell it for a few $1,000s more. But really, all of that was really our value proposition. And then on the pricing specifically, Kelley Blue Book, which has book in the name, it's not a dynamic pricing algorithm, right? It doesn't say, well, if your neighbor is also selling a blue Camry for $1,000 less than your blue Camry, well, your blue Camry is not going to be worth the same. Kelley Blue Book can tell you whatever you want, but like you're overpriced compared to your neighbors. So there's a lot of that is that has a lot of nuance. It's not obviously just what your neighbors are selling; it's what's selling at auction has a big influence. And your different options on your car depreciate very differently. So yeah, we spend a lot of time figuring that out.
Interesting. And you also were raising money and building the company. What was the entire process like? Because you ended up selling the company for less than $1 billion. And what are your takeaways on what does it take to raise money to grow a high growth startup?
Yeah, so we ended up going public just at the end of last year in 2020 via a SPAC. So that was an interesting process. And in terms of raising money, gosh, it was such a mixed. I could talk to you about this for hours and hours, right? So different stages, different things happened. So a lot of our early money was scrappiness, and to some degree, it was scrappiness, and we just were buying and selling cars off Craigslist, right? And we were selling the cars on Craigslist. We were buying them on Craigslist. These are what car flippers have always done. And so there wasn't anything all that unique about what we were doing. And people say, like, we didn't even have a website really, right? But people say, get out and market and you will learn things. And we did get out and market and we learned things just doing that. And one of the things we learned, and again, we're in San Francisco, was that a lot of the people who were selling their car with us were buying a Tesla. And this is very Bay Area, of course, but it turns out that Tesla doesn't want your gas car. They kind of turn up their nose at the gas cars. And so unlike a dealership, because they're a direct manufacturer selling their cars, they won't take your trade-in. And so a lot of people, they then have a car that, Tesla won't take as a trade-in. Anyways, we saw this as a great opportunity and we went and started sitting in all the Tesla showrooms. And essentially whenever someone was buying a Tesla, we'd be like, walk over and be like, hi, we are, we're here to help you sell your car. And so it ended up that Tesla appreciated it, and the buyers or the sellers appreciated it. And that led us to an interesting partnership with Tesla early on that led us, I think, to our Series A. I mean, that wasn't the only reason by any means that our Series A happened, but it certainly lended some credibility to us to have managed to secure a major partnership like that. And that was, again, just sort of happenstance by being where we were.
Right. No, this is interesting because you talked about SPAC, and there's been a rise of in SPACs over the last few years. What do you think are the primary drivers for SPAC, and do you think it's better than IPOs and direct listings?
SPACs are fascinating, right? Like, I don't have the exact numbers in front of me, but I think there were order of magnitude, there were about 300 IPOs in the US in 2019, let's say, total IPOs. And in February of this year, there were 100 SPAC IPOs. In March of this year, there were over 100 SPAC IPOs. So just like the landscape. And then April dropped off a cliff. I think there were like 10 SPAC IPOs. But I mean, it's just such a fascinating opportunity. It's an opportunity for companies that are sort of Shift size. Let's say Shift's about $1 billion company. I think you mentioned that, something like that. It's not a $5 billion company. It's not a $10 billion company, which it used to be that, the bankers and everyone else the markets were really there to take Airbnb public or something, right? The big companies, and you had to wait longer. And I think it's just going to have fascinating effects on, and so now companies that are $1 billion companies can go public via SPAC. And it'll have all sorts of effects for our industry, the venture industry, right? I'm a seed stage investor. And one, I think it means my portfolio companies will have opportunities to go public and we'll have opportunities for liquidity. But it also means, I mean, one interesting thing, I think, it's all early days, but there are all these SPACs with all this capital now. So, or companies that have just done this reverse merger that are now public companies. They have a lot of money, and they've got really intense growth projections that they've promised to their investors. And I think that'll probably lead to a lot more acquisitions. And so I think while it's mostly positive that our companies can get liquidity, I also think, maybe from a sort of weird VC lens, there might be a lot more exits in the $150 million exit because, or $100 million exits because they're the companies that have a lot of cash on their balance sheet. So it remains to be seen, but it's a big deal.
Right. Yeah, no, absolutely. Do you have any idea about the fee structure when we compare SPACs to IPOs, and what are the timelines for SPAC versus IPO?
Yeah, I mean, I think that's one of the advantages that is usually touted, which is that the costs and the timelines are shorter, smaller. My experience of it was yes, and I think that was a real appeal for Shift. And one of the reasons we decided to SPAC was because of the timelines, and there was a lot of market uncertainty when we were deciding to do this. And there was a COVID big, it was early days of COVID, and we really didn't know what was going to happen. And so that was appealing. So it's a compressed timeline, but you still have to do all of the things, right? And so there was an aspect of, great, it's faster, but it was like all of those things that you have to do to be a public company just get smooshed into a shorter timeline. So, the way we experienced it was as very intense. Now, I'm not at Shift, so I wasn't, part of that intensity, but I certainly, I'm certainly still close with all the Shift team. And so, and even just being a Shift founder and negotiating that, it was certainly an intense process.
Yeah, interesting. And when investors, when they evaluate SPACs, what do investors look to invest into? And if say a fund wants to invest into a SPAC, and can LPs back out if they're not happy with the SPAC partner they have?
Yeah, I mean, I don't. I sit in sort of the really traditional early stage venture role, and so I don't.
Right,
It's not like the sort of thing that I would do professionally, right?
right,
Is invest in SPACs as part of 10110. I think that there's kind of two types of investors, right? There are the investors who are investing into the SPAC, the blank check company, before it has identified a target. Um, and I think those investors have the option of getting their money back once the target is identified. So it's almost an option that they're getting. And with those, it's really a unit that they get. There are warrants attached to that. And that actually has been one of the big changes that the SEC changes, needing to treat those warrants, I believe, as liabilities as opposed to equities, although I'm going to be a little hand wavy here. But I think, those investors are seeing it as sort of this option, I think. And then when you go to raise your pipe, which is your, when once the target is identified and the SPAC and the target company go on their roadshow together, they work on raising a pipe, a private investment in public entity, I think is what the pipe stands for. And those investors, what you're trying to do there is almost swap out the hedge funds and swap in the long-term investors with long time horizons, so that your company then has investors who are in it for the long term and believe in the company and the company's long-term prospects. So there's different sorts of investors, sort of the first investors with a different sort of motivation than the investors who come in once the target has been identified.
got it. And I wanted to understand, what are the thesis behind 10110 Ventures, and are you sector and geography agnostic?
Yeah. So 10110, we're a early stage fund based here in LA. And our sweet spot is a seed stage investment. We often talk about it as engineer turned entrepreneur. We like the more techie things. Doesn't have to be, and we do very little in consumer. Not none, but like a consumer brand would probably be outside of what we'd be interested in. But there's definitely some, Shift is actually a consumer company with a lot of engineering behind it. But we like that. I have two partners, so there's three of us, and we are all engineers turned entrepreneurs. When I joined, so I moved to LA only a little over 2 years ago, and 10110 sort of had the reputation of being the nice and nerdy fund, which was very appealing to me. And I think, has that reputation for a good reason. And I think my partners have both built multiple large, huge companies. Gil's company was AdSense, which was, tens of billions of dollars. Google acquired AdSense, and David has had 3 venture-backed businesses. Anyways, I sit in the room with them, and I work with our portfolio companies. We have almost 80 portfolio companies at this point, and I learned so much. Like all of that stuff that I sort of thought I was doing one way, you get to watch your portfolio companies sort of approach problems in different ways. And then I get to watch my partners just be brilliant advisors, board members, and I go to them with a lot of my questions. So, I mean, it's been I didn't set out to be a VC, but it's been intellectually, it's exceeded all of my expectations.
Right. Well, that's
But your question was, what do we invest in? Which is, we're pretty much generalists. We like B2B. We have certain sectors like logistics, health tech, prop tech that we have like more investments in, but we're pretty open.
right. Interesting. And you talked about you have around 80 companies in your portfolio. How do you look at portfolio diversification and time allocation across portfolio? How does all the 3 partners decide on that?
Yeah, for the most part, our companies kind of outgrow us, and and it's great, and they get wings and fly off. So we work very hard alongside them to help them raise this Series A. Most of the businesses that we're backing are meant to be in the venture business. We're expecting to raise future rounds, and so we work with them to raise a Series A. We identify the partner at the firms who we think will be interested. And often once they sort of raise their Series A. Certainly once they raise their Series B, we're no longer on the board. We don't always even take a board seat. And, they've got just, SoftBank, they brings a platform with them, and they come in and, we still sometimes get calls, but, in terms of how we prioritize our time, it's usually with the companies that are still in that seed stage, sort of our more recent investments. And, most of our fund one investments are sort of off to the races, or some of them have sort of, not materialized. But for the most part, with the newer investments, we spend a lot of time with, when we get started, it's like a weekly meeting, maybe a monthly meeting, but it's pretty frequent.
Got it. And how do you look at reserve allocation across the companies that you invest in?
Oh, another one of those topics that you could talk about for hours. Gosh, right now we're about 1-to-1 in terms of we'll reserve the same amount as we put in our first check. But one of our things is just always listening to the market and what's going on. And so a big thing we talk about is getting as much allocation in our first check as we can. And so in our first check, that's when the valuations are reasonable.
Nice.
And so we're a reasonably small fund. And so we'll write $1 million check into someone who's raising, let's say, $2 million round, maybe a $3 million round. But, the valuations are still something where we can end up with 10% ownership, that sort of thing. But, hopefully if we're doing our job right, the Series A, the Series B, even if we write $1 million check, we're getting, little, maybe fractions of a percentage or something, right? Like, so it really is writing a large first check and then having reserves to support companies that might need like bridge rounds or that sort of thing. But we stop investing after the Series A because the valuations get too high.
Got it. And when you invest your first check, is it possible to have 20% stake in a company? And do you think ownership matters in startups, or is it more important to be in the right space in the right company?
Yeah, I mean, you can. So let's just say that we're investing $1 million. We can invest in companies that have a post money valuation of 5 million or 10 million or 20 million, right? And or anything else. But it's just balancing sort of the risk reward there and where companies are and what's been de-risked. And so it's nice. A lot of the companies that we invest in do have product in market. They've got customer validation, but they aren't yet, hockey stick growth, or else their valuations would be too high and they wouldn't, we wouldn't be there. We also like it when it's early because usually I guess it sort of makes us feel needed, but they don't have fully built out executive teams that have everything dialed in. And so there's still room for sort of generalist expertise, which is, I think, what we have a lot of operational generalist experience from a couple decades in places like Google. So yeah, I mean, we could invest at a 5 million post money valuation, but those companies are usually earlier. And we're not bargain shopping. I think if you just are shopping for bargains, then you're probably what you don't want to do is get so obsessed with the valuation that you invest in companies that don't have as good prospects. So I'd rather invest in the companies that are going to be billion-dollar companies than sort of always be too bargain sensitive. And yet I still need the allocation. So it's a fine line.
Got it. And how do you assess and think about market size in these times?
Yeah. Well, the thing it depends on my audience. When I'm talking to like MBA students, I tell them that I hate the Tam, Tom, Sam slide.
Right.
Because what happens is I feel like entrepreneurs now have studied entrepreneurship. And that's something that I hadn't done. And they study, and there's sort of a formula of what do VCs expect? And so people come and they make a Tam, Tom, Sam slide, and they go through the exercise of a bottom up or top down analysis because they think that's like what they are expected to do. And what I really care about is market size is I want someone who looks me in the eye and convinces me that it's going to be huge. Right. And some of that, yes, is I do need to understand like the used car market in the US is like a $1.2 trillion market.
Right.
I don't need to do much more than just tell you that and say, even if we were only, a couple percent, we would have a huge business. So it depends what business you're in. And yes, if you're selling toothpaste, I might need to understand how big the toothpaste market is and what percent of that market you could possibly own. But what I don't want is just like a formulaic answer. I want real vision on how big it's the vision aspect. It's the vision and the market size kind of combined.
Got it. And do you use any framework on how do you evaluate and assess competition when whenever a portfolio company is pitched? How do you assess competition for a particular company?
I would say competition we assess, but it's not probably it's definitely not in like our top few like things. It's there, and it depends on the company, how much we focus on the competition. But I'm mostly a believer that that you want to just execute on building the thing that that you set out to build, and not overthink what the competition is doing. That said, the other thing I really do care about is people who know their space extremely well. And especially because I'm usually doing B2B, well, it's probably true in consumer too, but I want, there's a level of expertise in the space that I care about. So it's not necessarily competition, but it's understand really well who your user is. And maybe it's why would they buy your product over someone else's, but just who is the buyer, who is the customer. Sometimes those aren't the same. What is their budget? How are they deciding what to buy? And that bleeds into competition, but it's more about the depth of understanding of the customer.
Got it. And Minnie, you've been a successful operator, a founder, and now a VC. But there are a lot of VC funding which has gone down for CEOs who are women in the last couple of years. How can we get more women to start more companies in this year and next coming year, especially in Southeast Asian economies and elsewhere in the world as well?
Yeah, I mean, many different ways. So some of it is on let's say the women, and some of it is on the systems, right? And I think it's both. And for me, occasionally I sit on panels where we talk about how hard it is to be a woman in these roles, raising money for me, having a degree in computer science opened a million doors for me. Like, I'm not saying everything was easy, because it wasn't, but it did open a ton of doors. So just encouraging women, like, it is a great path to be on, to be female and in startups and in tech. But I think a lot of it is also just us thinking about our systems for how we decide, not just who gets funding, but how decisions are made. And so, for me, it's at Google, like, let's say Google had Google product strategy meetings, and you weren't actually asking for money. Usually at Google, the resource was engineering resources that was scarce. There was plenty of money. But if the way decisions are made is you have to come in and pound the table and, pound your chest about your 5-year, projections, well, that might lend itself to people always getting funding, or the people who are sort of chest pounders. So I think we need to make sure that we are aware of how we make decisions, and that those decisions are being made in ways that, where we can actually hear and listen and make space for people who are, not table pounders.
Right. And, Minnie, you've also been a content creator. You run the Venture podcast. And you've done your 100 episodes. What were some of your biggest learnings while running the podcast, and any advice for me as well as for other podcasters on building a community?
Yeah, I mean, I love hosting a podcast. It's been the most fun. It's a ton of time for me. I think it does take a lot of time. I don't think I've done a great job building community, so you'll have to tell me on that one. I think that, I was chatting with one of my guests, Carrie Bennett from Upfront. She does amazing content, and she's a marketer by background. And she was talking about how people always say, look, I want to have a blog. I want to be a thought leader. And her question is, do you actually enjoy the work? Because if you want to have a blog so that you can be a thought leader, but you don't like writing, then it's going to be a horrible like pursuit for you. And so I think it's, for me, I love having my podcast where I talk to VCs. And so I actually enjoy the making of it, which makes it possible to keep doing it. It's beneficial for me because I am a VC. I was a new VC. I got to talk to all these experienced VCs about what they're doing. And then it's also given me more appreciation for content creators everywhere. And just putting yourself out there a little bit. Like there are occasionally like guests or episodes where I just like, that didn't really work. It was kind of boring. And then and I put it on myself. I feel like I didn't bring out the best in my guests. We still have to publish things. So, and I will say I edit mine probably more than you edit yours. I do think editing makes such a difference. Like it's just amazing. You can make your guests say things almost. I mean, I'm not manipulating my guests that much, but like they can sound much smarter or much more argumentative or much more self-deprecating depending on where you put the cuts.
Right. I think that's a very interesting insight, and maybe I'll edit more often in my podcast going forward. I quickly want to do the top three. What's your favorite business book?
Yes, you told me right before a taping that you were gonna. I don't read. I really don't. Like it. So that's gonna be my guilty confession. I'm not much of a reader.
Any newsletter or any podcast that you recommend people?
Oh, I mean, I podcast all the time. So that's some of it, is that I got spoiled because my news would come to me from like, I don't know, probably Kara Swisher. I do Pivot. I listen to all the pivots. I have a love-hate relationship with it. Now I listen to the All In podcast from Jason Calacanis, and again, love-hate relationship. Tech Meme Ride Home is probably like a basic, just give me my basic tech news on my ride home. So yeah, so that's probably where I get more of my news nowadays.
Got it. And if you could go back in time when you started working with TenOneTen Ventures, what is the one thing you would have focused on or done anything differently?
Yeah, I mean, throughout my career, and probably even more so in Shift, I think I probably would have just done more, like less worrying if I could. Like that would probably be if I could like go back and tell myself some advice when I was a younger self, I would have said like, don't worry about it. Like it's like there are times it sucks. Like everyone would say, isn't Google the greatest place to work? And at times like my projects were late and I didn't like my manager and like, and I think I would try to tell myself it'll all be fine. It'll turn out fine. But like sometimes you just have to sort of mantra I like is show up, tell the truth, hope for the best. Right. And like sometimes you do that and it's not enjoyable, but you just have to keep doing it. And then at times it gets better.
Got it. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
Yeah, I mean, to go back to what I said, my favorite tool right now, and it's so good, is Descript. Descript is the best podcast editing tool or just editing tool. I only use it for podcasts, but it's incredible. And it made me inspired. It's so good that now I'm doing like oral histories. I just did an oral history, I guess, with my dad. And like, because it's so easy just to record someone, you record them on Zoom, and then you can edit in Descript. And I feel like everyone should become audio content creators because it's so easy and fun to do.
Yeah, no, absolutely. I think Descript is also one of my favorite tools. We'll put that in the show notes. Minnie, what is the best way people can reach out to you and know more about TenOneTen Ventures and LA Venture podcast?
Yeah. So, I mean, they can, they can just go and give my podcast 5 stars. They don't even need to listen. They just, LA Venture. I'm pretty responsive on LinkedIn, like to thoughtful messages. That's probably the easiest. That's how I get a lot of cold inbound, and I try to engage as much as I can.
Got it. We'll put that in the show notes. Minnie, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Great. Thanks for having me on.